Today we delve into the fascinating world of Vanguard LifeStrategy Funds. For those of you who don't know, Vanguard actually has what are called LifeStrategy Funds, where you can take your entire investment and much like a 401k or even an IRA and do what's called a target date fund and move your money into those where over time, depending on what you've selected, your investment will either become more bullish, less bullish, more conservative, less conservative. So think of instead of investing in a bunch of ETFs or index funds, you're able to actually say, I'm 20 years old today, I plan to stop working at 60, or I need my money at 70. And then over time, it can help you move things in a way that will replicate what your lifestyle looks like. So maybe you're more conservative, maybe you're more aggressive. These things can help. Why is no one talking about this though? I've rarely ever heard anyone bring up the fact that these lifestyle funds even exist. Why is that? Well, that's what we're going to go over today. So I want to appreciate everyone tuning in. If you find this interesting, go ahead and smash that like button, and I'm going to and leave a comment down below of what you think about these life strategy funds. So right off the bat, how do these compare to other options? So the first thing is we need to define what these lifestyle strategy funds are. So really on the Vanguard website, it says, how do you divide your money between stocks and bonds? Makes sense, right? I've talked about a 60-40 or a 70-30 fund here before, where you've got 70% in stocks, 30% in bonds, or 60% in stocks and 40 in bonds. What does that look like? So this really goes through and says, hey, we're going to hold all these assets. We're going to move those around as things in life change. So as you get older, you generally take on less risk and you move from more stocks into bonds. Now, the interesting thing here is it's not just one fund. There's several different funds you can choose from. And they break these down here. There's 4. And it tells you the fund name, the event time horizon, the target allocation, and the risk potential. We're going to go through in just a minute the risk potential and what does that mean, and then how do you determine which lifestyle fund you need to get into or should get into if you're looking at this. And it's pretty simple. You have an income fund that's more for the 3 to 5 year, I would say 3 to 10 year, where you're getting sort of that passive, I wouldn't say passive income, but as stock prices go up, bond prices go down, and vice versa. There's an inverse ratio there. But as you can see, it's a small risk potential because you've got 80% in bonds. Bonds aren't typically as volatile as stocks. You move down here to these 3 though, and these are the 3 we're gonna touch on. You've got a conservative, moderate, and then a growth. And really all that means is as you go from conservative to moderate to growth, you go from 40, 60 to 80% stock, and then you go from 60, 40, 20 down to bonds. Now, the great thing is they do give you a asset allocation questionnaire to fill out, which I'm not actually going to go through, but I would advise you if you're looking at this to go ahead and fill that out. And one of a couple of the big things they say here is lower your risk through diversification. So in this case, let's say you did take $100,000 and you put it all in VTI or VOO. Those are great ETFs. Those mirror the S&P 500 or the total stock market of the world. You get a little bit of everything. There's nothing wrong with that at all. But in that case, you don't have any cash, you don't have any bonds, and as you get older, you typically want to have less risk. So maybe VTI, maybe VOO are too aggressive for you when you start getting into your elderly years. Save time. So each fund is professionally managed. So you are going to pay a fee because these are mutual funds underneath. I don't know if I think I forgot to mention that, but underneath all these are mutual funds, and the mutual fund to the index fund to the ETF, the mutual funds are actively managed portfolios. So you're going to pay a higher expense ratio. So don't forget about that. Make sure you understand the fees that come with something like this versus just putting your money in and saying, well, I've got a life strategy fund, I don't have to worry about it now. You really need to compare the fee structure and what that looks like from doing it on your own or maybe using another robo-advisor like Betterment. And finally, you've got lower cost. They say the expense ratio is 79% less. I haven't invested in, doing research for this video, I did see that their mutual funds, like most of Vanguard, are cheaper than some of their competitors, whether it's BlackRock, State Street. Vanguard just generally has the lowest expense ratios for ETFs and index funds and mutual funds out there. That's one of the big reasons they hold so much capital is their expense ratios are lower, which means you get more capital to work towards appreciation. So if I move over here to compare it, you've got a VTI, like I mentioned a minute ago. VTI is an index fund, or an ETF that mirrors the index. You can also get these as mutual funds, but some of the key differences are fees are a little bit higher, fees are a little bit lower, 0.03. You're also only getting exposure these different sectors here, and in this case, a lot of this is fixed equity. this is equity, and you're getting 6% as Apple. So maybe you're not comfortable with 20% of your portfolio or whatever being in tech. If that's true, then you may want to look at a different ETF, and you may actually be a good fit for this lifestyle fund. However, if you feel like, hey, I've got a longer runway and I've got 3,895 stocks are in here. I mean, it's a lot. So you've got a lot of diversification. You just don't hold any bonds and you just don't hold any cash. Likewise, on the VOO perspective with Vanguard, you've got a very, very low expense ratio, 0.03. It doesn't really get any better than that until you go to basically zero and you start buying up stocks yourself. But to have this be an index that is just tracking what the S&P 500 is doing for as low as the expense ratio is, 0.03 again, to have exposure and to see what this thing has done over time is just, it really doesn't get any better. However, in this case, you only have 505 versus the 3,800 in the VTI fund. Some people would say that it's interesting because how do I determine what risk looks like and where do I go from there? So there's actually, I'm going to link this down in the description. This is Investopedia, gives you a ability to see, okay, even if I go with one of these lifestyle strategy funds and I want to offload complete control, how do I determine my risk tolerance? Well, a couple things. One I've talked about before is time horizon. So how much time do you have? So someone starting at 60 is very different than someone starting at 20. 60 is going to want to be more conservative, have more bonds than stocks. Someone at 20 is probably going to want to go for one of these probably this growth fund here. The other one is bankroll. So how much do you have to invest? So if you sums it up here, you need to figure out how much money you can afford to lose if it were to go that way. And this really sums it up well. Compare, if in instance, a person that has a net worth of 50,000 to another has 5. If they both invest 25,000, the person with 50,000 is going to take a bigger loss than the person with 5 million. And then the risk pyramid, if you look here, you'll see bonds at the bottom, you'll see CDs, collateralized certificates of deposit, notes, bills. Then at the top, you'll see options, futures, and collectibles. I definitely wouldn't advise anyone to get into options or futures trading unless you really know what you're doing, but most of it's middle in here. You've got small, mid, large cap stocks. And then you've also got some interesting info down here around, why are stocks more riskier than bonds? Basically because the volatility that comes from those stocks can be much higher. Now, if I move over here, this is another article from Portfolio Einstein that I'm going to link. What's been the historical return of Vanguard's lifestyle portfolios? And everyone wants to know, are these actually beating the market? So this is as of June 1st, 2023. So very, very fresh data. The lifestyle strategy income, which is the 20% stock, 80% bonds, 2.58% year to date, 10-year return, 2.85. Drawdown's not too bad. Expense ratio is very low. And the yield is great. Now, if I go down here at the lifestyle growth fund, that's 80% stocks, 20% bonds. Over the last 10 years, you're averaging 7.5%, which is great. These are all hands-off options where you don't have to do anything. Set it and forget it. You're either adding money. Hopefully you're not taking money out, but it shows that there is a profit to be made here, even when you're, paying such a low expense ratio. And I should mention all the expense ratios for these is 0.05. So then how do they actually compare to some of the other portfolios out there? So the lifestyle income fund, and these are all underneath, have Vanguard ETF or Vanguard mutual funds in them. You could see the income fund, which is mostly bonds. It's got 56% total U.S. bond market. And as I move down here, you've got the total U.S. total stock market, which is right here. So you've got VTI. It actually uses this ETF underneath it, and it puts it right here. And then you've got most of the rest of this is bonds. Now, you can again go through and create an ETF yourself and invest in one single ETF. However, I think for people that are looking for a truly hands-off approach, much like a target date fund in your 401k, this could make a lot of sense. This is another site I'm going to link down here, but this is I think Pension Craft did a great job reviewing the Vanguard Lifestyle Strategy Funds. It actually goes through and shows you what it looks like if you have 20%, 60%, 80%, the volatility. So as you add more equity and more stocks, the volatility goes up, and as you add more bonds, it goes down. One of the interesting things I found while doing research for this video was if you had just bought individual stocks or individual bonds, as the stocks went up, the bonds went down, and then vice versa. At the end of the road of a 10-year time span, these Vanguard lifestyle funds actually put you right in the middle. So again, stocks and bonds are going up and down all the time, depending on the economy and depending on other factors. I thought it was really interesting that no matter whether you did it yourself or you used one of these funds, things would kind of end up in the same place at the end of the road. The other thing I look at here is this actually shows over the last 12 years what the equity positions look like, what 100% equity. And as I thought, the S&P 500, in this case, if I tracked an index fund like VOO against these lifestyle funds, I would have actually made more money. But we've been in a bull market over the last 12 years up until 2020 when we hit COVID. So what's in these funds? Basically, it's just a bunch of mutual funds that sit under here. So really, you're going to get all Vanguard funds, which is great from an expense ratio, so you're not having to trade in and out and the brokerage. And then you've also got a good mix of UK, European, Japan. And down here, you can actually see the percentage of each. So as you, again, move into equities and out of bonds, you're seeing the difference here. The last thing I wanted to go over is why Vanguard Lifestyle is outperformed the market in 2020. Again, you had so much volatility in 2020. You had stock prices going up, you had bond prices going down. This was, of course, after COVID hit in March, but you saw a pronounced dip, a slide off. We entered a recession. There was a 20% drop in equity. Then we went back up as they infused cash into it. If you look over here, basically this article comes out to say that the lifestyle strategy fund can outperform in the long run. Again, that's why you want to have a very long-term perspective on this. But I'll link this down in the description as well. Finally, going back here, if I double click on one of these, and this is an 80% stock portfolio, VASGX, which you can buy these as index funds if you want to. If I look at just this one, this is an 8.4% as of yesterday, a 6.7. One of the interesting things I found about this is some of these inception dates are much earlier than the ETFs that you can buy, like VOO or VTI. So some of these actually do have a longer track record. And then if I go to look at performance annually, I can go all the way back to 2008. If I look at income return by net asset value, you're continuing to see this go up. And then obviously in 2020, did pretty well. 2019, it was great. And then if I go back to 2008, when we had the housing crisis, it was down 34%. The interesting part though is whether you're doing this alone or not, you kind of end up at the same place. And with how low these expense ratios are, 0.14, it's really hard to make the case that you should be doing this on your own. Now, I will say this is the first one of these lifestyle strategy funds I've seen. I'm going to do some other videos, maybe BlackRock, State Street, and see what they have. I'm also going to do another video that looks at, which I thought of while I was prepping for this video, is how do these lifestyle strategy funds compare to something like a Betterment or a Wealthfront? Because with Betterment and Wealthfront, all they're doing is buying Vanguard, BlackRock, State Street, iShares, and rolling those up, doing tax loss harvesting, moving you in and out of positions. So I think this could be an interesting comparison of what that looks like. So leave a comment. Let me know what you think of these. Would you be interested in investing in a lifestyle strategy fund? Have you invested with Vanguard? Let me know what you think. Also, if you like these types of videos, let me down in the comments below. Don't forget to smash the subscribe button. And as always, don't forget to design your financial freedom. Take care. Bye-bye.